Good afternoon, everybody. I hope everybody's doing well today. Happy New Year if I haven't seen you already. Welcome to the fourth quarter 2022 update, as well as the 2023 outlook. We'll be letting people in as they come in. But if you guys have any questions, we'll address those at the end of the presentation. So at the bottom of the screen, there's a chat function. You can type any questions that you may have inside of there, and we'll address those at the end of today's session. So it should be about 30 to 40 minutes. There's a lot to cover. A lot happened not only last year, but we think that a lot's going to happen this year. So we're going to kind of go over the market progress and then go over some of the tools that we monitor for recession watches. And then we'll wrap it up with some Q&A. So if you do have any questions, make sure you submit those in the chat section, and we'll be happy to go over those at the end. You ready to rock and roll, Carl?
I am. So we have updated versions of charts that you've probably seen before, and we have some new ones as well. So we might go over the ones you've seen already a little more quickly than we did in the past, but we'll go over it all, and you'll see why we are real confident in how we're positioned right now.
Sure. So to keep the regulators and the attorneys happy, here's all of our disclosures. We're going to start with that. So any of these views are obviously as of January of 2023. You can't invest directly into the S&P 500 index. But outside of that, here are all the disclosures. Now let's have a little bit of fun. So we started out this presentation with a picture of a goldfish, and I thought it would be important to, really remind people that a lot of things in the short term can happen in a marketplace on a month or 6-month period of time. But the constant that we continue to see is that a lot of normal investors out there have the attention of a goldfish. And what we mean by that is, if the market tends to be trending up for a little while, or a stock tends to be trending up for a little while, they want to chase those things. So we don't want to be a goldfish in 2023. That's why our word of the year is patience. And it's because for the first time in 12 years, investors are actually getting paid something to be patient and allow the fundamentals to either deteriorate or hopefully improve. So we don't want to be a goldfish in 2023 because sometimes it does take time for the economy to slow down. But inevitably, what we'll be talking about today is some of the things that we're watching on an economic and a market basis on what we think is going to happen for 2023. So, if we look at the market for last year, this is a chart of the S&P 500 that goes back to basically the COVID highs in 2020. But what you can see over here on this right side of the chart, what we've got is the blue line is the 150-day moving average, and the orange line is the 200-day moving average. You can see there's significant signs of higher low prices, as you can see by these points, as well as lower low prices. So you can basically draw a nice trend line channel, both top and bottom, in this trading range that we've really been in for the last 12 months. We've been hitting this technical support of the 200-day moving average pretty consistently. You can see we broke through it a little bit here, touched it here down, touched it here down, and we're now back to that downward trend. So technically, from a technical standpoint, the market isn't healthy, which isn't a good sign when we're coming into, potentially deteriorating earnings, which we'll address here in a little while. Anything you'd like to add from a technical perspective, Carl, for the S&P?
Not much, but that's a very well-defined downtrend. Usually you can draw lines connecting peaks or valleys in a market, but there are actually 4 of them in a row there. We didn't actually draw it on there, but from the peak at the end of last year, you can see there's actually a clear line there. So, right. And the key thing right now is that the environment keeps getting worse, and the Fed is nowhere close to easing. So we don't expect any change in that.
I completely agree. And just how bad of a year was it, right? So these two distribution charts show bonds on the left and stocks on the right. And you can kind of see not only was it a bad year for stocks on the right, and you can see in here, it goes back into the 1800s, historically for stocks, but also for bonds. It was the worst year for bonds in, basically almost 100 years because of the rapid change of pace of interest rate hikes that the Fed embarked on due to combating, a 9% inflation rate is, roughly where it peaked out. So, for an average investor, even if they were in a 60-40 portfolio, you didn't get any shelter from bonds like you typically would in previous years because of the rapid change in interest rates. So historically, a bad year, not only for stocks, but also for bonds.
Right. So it's rare that you can have a few years in a row that aren't good for stocks, but it does happen. And we believe that that's likely to happen here. But if you go and look at the years over on the bond side of that chart, it's harder for you to have multiple years that aren't good for bonds, because for bonds, the coupons are not are not at risk, while the earnings for stocks are. So
Right.
you can often go and look at the worst years over there for treasuries, and you'll see that very often the next year is positive, and some of the best years were right after some of the worst years.
Right. Yeah, no inherent earning risk when you own a bond, just default risk. So talk to me about this, Carl. This is a longer term view of inflation that goes back to 1915. It shows all the inflation spikes going back to 1915, whether that was, the huge infusion of capital during the wars, or the great inflation during the 1980s, or the deceleration of inflation basically from the 1980s until, essentially COVID, and then the huge COVID surge.
So there are a lot of different reasons that you have inflation. Wars are often real inflationary. There's a lot of increased industrial production and energy use associated with them. Great Depression was more of a central bank failure and banking crisis situation. The last big pandemic in 1918 is kind of masked by coming off of World War I, but usually pandemics are deflationary because you lose a lot of people and demand as a result. But the world was so globalized this time, and we had the technology to have everybody kind of functioning remotely, that there was a lot of demand for goods during the COVID surge, and you didn't have supply chains functioning around the world to really deliver everything. So we had that inflation as a result. But the key thing to note from this is that the valuation of the S&P 500 tends to relate to how much inflation there is and bond yields. And generally, the higher inflation is and bond yields are, the lower the valuation on the S&P 500. The point being that we still are in that 4 to 9% range, and it's going to be some work to get us down to 4. But the average in the past for the S&P 500 earning, PE has been 14 when we've been in this range, and right now we're at about 17, and that's on, earnings as they've been expected, but don't account for any declines yet.
Right. Yeah. So what I want everybody to do, if you've got a pen or a paper next to you, where I highlighted that section down below, that what Carl's telling is that's the average valuation of the market from a PE standpoint when inflation is at different levels over here on the left-hand side. So currently we have inflation running at roughly 6.5. It would be a great ordeal if the Fed was able to get that down to even 4. But between 4 and 9%, historically, the average PE of the stock market is roughly 14 times. So if you could just write down, 14 or 15, it doesn't matter really which one. We'll use that a little bit later today. But, what Carl, just to summarize what you said is, the valuation of the market is high compared to where inflation currently is, right?
Right. It's high. It's probably a little higher than it should be, and it's a little higher than it should be when you account for the likelihood of earnings declines. So we'll show more information on that as we go.
Yeah. So this is the Fed hike path, right? So this goes back to 2004. You can see that massive move up from 2022 of what they did last year. They're expected to raise rates at least 2 more times. That puts us in the range of almost 5%. And then by December of 2024, have that Fed funds rate down to 3%. So what the Fed has told us coming into this year is, we have to continuously combat inflation. And our path is that we want to keep interest rates higher for longer. That's a term that they use. Anything else that you want to add to this before we jump to that next slide, Carl?
No, this is just the current expectations, and we're getting better visibility on it. It probably won't change a lot, but things could happen and it could change.
Right. Some big things that got affected last year, obviously, were housing, right? So I think here in Las Vegas, we gave up all the gains from 2021. We were down about 12 or 13%, I think, from the peak in July. But this comes directly from Goldman Sachs, where they are predicting, at least a 10% depreciation, if not more, across the country. And, our nice city of Las Vegas right here, that's about another 12%. So from peak to trough, potentially housing has the potential to be down, somewhere around 20 to 27%. When everything's said and done, just for, from peak of 2022 till now. And Carl, tell them why that's so important, the housing market, when it relates to the economy.
Well, it's so important because the housing is really the largest asset class. US stocks are somewhere around 30 trillion or so. The fixed income market is even bigger than that, but real estate is even bigger than both of those put together. When you think about all the value of all the homes that are out there, the buildings, for all different kinds of uses, industrial, commercial. And for most people, their home is their largest asset.
Right.
And, when financial market assets decline in value, people often talk about a negative wealth effect associated with that. But, the wealth effect with housing is actually stronger, not just because it's a larger asset, but because for many people, it may be a bigger share of their total asset value or net worth. And they may not own as many stocks and bonds relative to how much home equity they have. So when that declines in value, people don't feel as good and they don't feel like spending as much.
Sure. Yeah. And I think I read a statistic that real estate in general makes up about 20% of GDP. And we were just coming off a year where we just got existing home sales that came out this morning, year over year, down 18%. And if we see another year like that again, that has a big bite on the GDP of this country. So just something to point out when we're looking at, what the Fed's trying to tell us that they're going to do, which is not cut interest rates basically, until next year sometime, versus some of the things that we're already starting to see the ramifications of higher interest rates and some of the predictions of what's going to happen to housing next year. So now we want to kind of transition into, what we call recession watch. And the problem with, calling for a recession is obviously being Nostradamus and picking the exact date when it's going to happen. But what we're here to tell everybody today is that the deterioration of the economy is not slowing. It's actually only, accelerating. So we're going to go through a few of those items today that kind of point towards the deceleration of the economy and how close we think we are to the actual recession. So all of last year, 2022, is the notion about a soft landing. So a soft landing is defined as when the Fed is raising interest rates and you do not go into a recession. So that happened only 3 times in almost the last 70 years, all of which inflation was under 4%. So
and not only that, they didn't have to raise the Fed funds rate that much.
Yeah, you can see here they're not.
Those are some of the smaller peaks on the whole chart there, and you can see that often how much the Fed funds rate had to be raised prior to the recession. It tends to correlate a bit with the length and severity of the recession too.
Right. Yeah, and something interesting. I was just watching The Big Short, and in The Big Short, they overlay real life commentary from like CNBC and other news networks inside of that movie. And in 2007, they were showing clips of all the commentators talking about the housing market and how confident they were that we were going to have a successful soft landing. So it's nothing new calling for a soft landing, but the probability of having a soft landing is very low, specifically when inflation is above that 4% target level. And typically, anytime inflation is above that 4 or 5% level, the only medicine to cure that is to have a recession. So
And
we're not in the camp that we have a high probability of having a recession or a soft landing.
right. And we're gonna, when all is said and done, we will have had about 500 basis points of rate hikes and quantitative tightening on top of it.
Right. So again, this is just an historical chart to kind of bring everybody up to date on what happened historically back in the 1970s and 80s. This chart looks back, going back to the 1960s to the 1980s. The one thing that we do want to point out here is that, to truly squash inflation, the Federal Reserve has to get the federal funds rate, which is this purple line, above where CPI is, at least at some point in the cycle. And that creates real rates, right, Carl?
Right. That, it makes people less willing to borrow and more willing to save and helps slow things down.
Right. Now, despite the Federal Reserve telling us that they're going to keep interest rates higher for longer, the Eurodollar futures, which is an indicator that we watch, is currently pricing in a rate cut. And so is the bond market, right, Carl? Currently
Right.
pricing in a rate cut in September.
So Eurodollar futures are how global banks hedge their US interest rate exposure. And you can see they're priced just like a bond, and you can see there in September of 2023, because the value of that contract is higher than the one in June. There's an implied rate cut there, even though the
Right.
Fed governors came out a few weeks ago and said, no, we don't really see a rate cut this
You
year.
mean the same Fed governors that said they were only raising interest rates to 1% last year?
Right. I mean,
Yeah.
they're doing the best they can.
Of course.
They don't totally know where things are going. And typically markets tend to be better at adjusting and forecasting all of this than even the Fed governors.
Right. Everyone's human. But so despite the Fed telling us that they're not going to be cutting rates, the bond market and the Eurodollar futures are telling us that by September, you should see a rate cut. And, why that's, important is because what we're seeing in the deterioration of the economy, I think the bond market is starting to sniff that out. So this is what's known as an inverted yield curve. You may have heard it, the talking heads, mentioning this a lot on CNBC or any news network, inverted yield curve. Essentially what that means is that the short end of US treasuries or T-bills are paying more interest than the long end, like a 10-year treasury. So what this blue squiggly line is the difference between what a 10-year treasury pays and a 3-month treasury pays. This line going across here is 0. So essentially, anytime this blue line goes below 0, that means that the 3-month is paying more interest than the 10-year. And you can see inversion, recession, inversion, recession, inversion, recession, inversion, recession, inversion, recession, the deepest inversion since the 1980s. The next word to follow would be recession. The problem with looking at the yield curve inversion is that it's the timing metric. It can be as short as 6 months. It could be as long as 18 months. So we inverted in October of last year. So that gives you a pretty big runway on using this as an indicator of an oncoming recession, but the success of using this as an indicator is really high. And one important thing for everybody to realize on why an inverted yield curve is a recession indicator is because of the banking system, right? So the United States and the rest of the world basically runs on credit, the issuance of credit. And when interest rates are really low, banks don't really have to pay their depositors a lot of interest to keep their money at the bank. So when they make a car loan at 5%, that net interest margin is roughly 5%. Well, when interest rates on the short end start to rise because the Fed is increasing rates, then now they have to actually pay their depositors more interest just for them to keep their money at the bank, which then means when they make those loans, they're making less interest to take that risk. So what happens when you tend to get these inversions is the banking system as a whole starts to tighten their belts and get a little bit more selective on who they're making those loans to. And we'll use cars as an example. So if you can't get that car loan because the bank doesn't want to lend that money out to a subdued FICO score, well, the dealership doesn't sell that car. Then the dealership doesn't order new inventory. Then the car salesman doesn't make the commission and then go buy a rental property or a new Rolex watch. Then the dealership doesn't service those cars because it wasn't sold. So you can see in just that one example how credit, or the lack thereof, really starts to domino inside of the economy. And that's just one example of the issuance of credit and why the inverted yield curve, when those short-term interest rates start to rise, can really have an impactful, dent in what the economy is doing. Did I summarize that okay, Carl, to your liking?
That was great. I would add that banks still are not paying people much on their savings and checking account deposits,
Right.
with the result that people are taking their money out and putting it into other things where they can get a yield that's closer to what is in T-bills.
Yeah.
And the result of that is that bank reserves are dropping like a rock, and we have a chart on that.
Right. Yeah. And yeah, I didn't mean checking or savings, but it's still a bank reserve if someone moves it from a savings account to a 6-month CD or a 1-year CD, if it's still at that banking institution. But my point being is that for everyone that moves over to a CD, it's less net interest that the bank makes on credit issuances.
Right.
So let's talk about this. I'll let you lead with this one, Carl.
This is a chart of the OECD leading economic indicators. And every time we get into we get close to a recession, this is already starting to decline a lot. And it's in the range below 100, like as we're going into a recession, and we're right there at that line where it's on the brink of a recession. So, there are different sets of leading economic indicators. This is one, and I think we have another one.
Right.
The next few slides, the conference board.
Yeah. So just from an economic standpoint, we're getting a lot of indicators that are signaling, at least historically, that we're on the precipice of a recession. This is the one that Carl was just talking about, the leading economic index, where it looks at manufacturing data, production data, among a number of other things, on signaling a recession. And on this one, Carl, this blue line looks at the year-over-year change, right?
Right. And usually when it's declined about 5%, you're right at the beginning of a recession or so. And we're about right there right now.
Right.
So, we're kind of on watch for a recession to be starting any time, really. But,
Which is this line here.
The National Bureau of Economic Research won't announce that for probably, 6, 9, maybe 12 months after the fact.
Right. But another sign that we're getting economic reports that the economy is deteriorating, even though when you drive around or when you fly in an airplane or when you travel or when you go out to dinner, it may not seem like it. The real numbers that are being reported are actually showing that we're seeing a further decline in economic activity. This is that same leading economic index again. Remember that -5 number here. And typically what you see is these warning signals. If it starts to dip below, like what it did in 2016, what it did in 2012, those are warning signals. But typically when you get down into this range, you not only get those warning signals, but you also get the signal for a recession. So you can see in 2007 or 2008, we had the warning signal that lasted for basically 18 months there, Carl?
Mm-hmm.
And then the recession was triggered. 2001 recession was a little bit faster, but you got the warning signal here in late 2000, and then the recession in 2001 again. So nothing from a rosy standpoint when it comes to the leading economic index, as far as signaling a rosy picture for the economy.
Right. So everything that we look for to identify an oncoming recession has happened, except labor market weakness. But every week that goes by, we continue to see news of significant layoffs at large tech companies, and we're starting to see more of that in other industries. And probably the coming weeks will have even more.
Right. So I'll let you handle this one. This talks about the S&P 500 performance around recessions, Carl.
Right. So it varies a lot. A lot of it comes down to, how frothy things got beforehand, how long it takes to slow the economy down. COVID 2020 was very short because the Fed got in there and the Treasury as well, and really hit it hard with stimulus. These bigger ones where there's a wealth destruction, like the housing crisis in 2007, 8, those tend to be longer, tech bubble, 2000, 2002. But point is that, the average decline after a recession starts tends to be about 10 months.
Yeah.
But it varies.
Yeah.
And here we're looking at a key variable on, to try to get a better idea of like when the market bottoms. And typically it's when the unemployment rate is going up the fastest and jobless claims are peaking.
You mean when everybody's panicking?
Right. And it makes total sense because when people are losing their jobs, they're scrambling to probably file for unemployment, and then they're looking at their retirement accounts, and if those have been damaged and they think they might need some money to live on, they might be getting scared and thinking about getting into a more conservative asset allocation, even when that's the worst time to be doing it. But because so many people behave that way in the same way, that tends to be what puts in these big market bottoms and recessions, a few weeks or months after, the unemployment rate is really peaking, that's when there's the most selling pressure, and that's when stocks tend to bottom.
Yeah.
It varied, but that's generally what the pattern was.
Yeah, the market typically bottoms close to or around when jobless claims peak. Another thing that we like to tell our clients is to remember that the market always bottoms before the recession is over. I'll just quickly go back and look at this chart. This is just the 60s to the 80s. The white line is the S&P 500, and you can see market bottoms here, recession ends here, market bottoms here, recession ends here, market bottoms here, recession ends there, so on and so forth. It's a repeatable pattern. Why is that? Is because the market is a forward-looking instrument. And typically the best time to buy is when everybody's selling everything and running for the fire exit.
Yeah.
Now, this is something very important that relates to what we asked everybody to write down, right, Carl? We asked everybody to write down either 14 or 15, so we can do a quick calculation with you, okay?
Right. So typically in a recession, S&P 500 earnings decline 20% or so. If there's more bad stuff going on, it could be more, like in 2008 to 9. But you can see over here that the analyst estimates haven't been revised down yet. So we're still up there at, we're going to see how fourth quarter earnings come in. And then, we're still got analysts expecting almost $230 a share here in 2023. Now, there could be some inflation, and, it may not be, it may not go down like 20% from that, but, to the extent that happens, bond yields may remain stubbornly high, with the result that the valuation has to be lower. So, you can do some rough calculations on this, and, just very simply, if you thought that, earnings need to probably go down to $200 for the S&P 500, and the valuation should be generous. Let it be 15. That right there is 3,000. That's a big drop from where we are right now, almost at 4,000. But I mean, it could go down a little bit more than that, or maybe not, or maybe the valuation could go down a little bit more than that. That's usually what happens in a recession. People get scared, and sentiment goes from positive to fairly negative. So,
and pretty quickly too.
Yeah, and it can happen quickly, within a quarter or two. So, I mean, you can see how with those numbers, like you could get to an S&P 500 target somewhat below 3,000, maybe 2,500.
Yeah, and that's scary, and we're not calling for that, but this is so important. This is one of the most important charts that we can show you. So not only have we just presented a number of indicators that are telling us that we're on some kind of a precipice of a recession. And we're going to get into a few more after this slide. But earnings, what companies earn, has a drastic impact on the value of their company. So what everyone needs to realize is in 2021 or 2022, the decline of 20% in the S&P 500 or 30% in the NASDAQ had virtually nothing to do with corporate earnings. For the most part, corporate earnings held up relatively well. There were certain pockets of the market that, earnings completely exploded, but as a whole for the S&P, earnings estimates held up relatively okay. This year, it's all going to be about earnings. And if we are to have a recession, the average earnings decline, at least in the 3 previous recessions, is somewhere around 20%. So if S&P 500 earnings just go from 230 just down to 200, you take that historical multiple that we wrote down, like Carl said, that 15 times when inflation is somewhere between 4 to 9%, take 15 times 200, and that gives you an S&P 500 value of 3,000. Doesn't mean that it's going to drop off a rock and go right there, but inevitably, whenever this recession starts, if we get, even if earnings decline only 15%, 230 times by 85% gives you 195. You're right there, times by even a 16 multiple, Carl, that's 3,100, right? Mm-hmm. So 3,000, 2,800, 3,100, 3,200, that's somewhere between 20 to almost 30% from where we're at currently today. And why that's important to understand is because the recent drop only took the excessive valuation that was out of the market out. What's left is earnings compression, and bear markets typically follow 2 phases: valuation compression in the beginning, earnings compression at the end. So this is how we get to, that target range of, somewhere around 3,000 for the S&P 500. Doesn't mean that we're going to go there next month or, even in the next few months. But as this recession develops and matures, there's a higher and higher probability that what we're talking about today will come to fruition. Did I summarize that okay, Carl?
That's perfect.
Oh, that's great. Perfect. Great. So this now talks about earnings. And I want to focus, let me delete that over here. I want to focus on that chart on the right a little bit more, Carl. But
yeah,
essentially,
that's fine. We hit the one on the left.
Essentially, what we're seeing is earnings typically, or the stock market, the stock market typically follows earnings. And what we've seen at the end of this year is this huge gap right here between what the earnings estimate is and where stock values are, okay? So again, if history is going to repeat itself or follow trends that it's done historically, there has to be some form of a compression here. Now, could the stock market also go up to that, Carl?
Sure. Anything could happen in the short run.
That's exactly right. But again, there's a huge disconnect between where stocks are at and the estimate for earnings. And I can promise you one thing, Wall Street typically, at least the analyst,
they're typically wrong.
Underestimate what earnings are, especially around recessions. Last thing, again, declines in earnings at the heart of major bear markets. So this says the S&P 500 earnings per share already declining. Bear market will end when a recovery is on the horizon. So again, the S&P 500 is here. Earnings are up here. And you can see this goes back to the 90s. They're pretty lockstep, right? Earnings in blue, stock market above. And now you've got this huge disconnect. So this gap needs to get filled either one way or the other. And what we've presented today is that the deterioration in the economy, even though it may not feel like it when you live your everyday life, is currently present, and it's not progressing to the upside, it's declining to the downside. I'll let you do this because you just threw this in.
Yeah, I mean, here's a little more this is a little more detail on what we already went through on how you get to, those 3,000 or low 3,000 S&P 500 targets. Just thinking about, on the top, how much earnings could decline and what kind of valuation should you put on it.
Right. Yeah. So again, this is another way for that calculation that you did on your own. These are S&P 500 earnings here. So if earnings from today are to drop just 10% and it trades at a, 15 times multiple, 16 times multiple, then you're back there at a 3,000 S&P 500. If earnings in a recession drop historically with what they do at a 20%, and we're at a 15 multiple or 16 multiple, that puts the S&P at 27 or 2,800. Or if you're at a 17 or 1,800 multiple, or 17 or 18 times multiple, which is roughly where we're trading at now, right? We're 18 or 19 roughly, or 17 or 18. 17. So that gives you a value of 3,000, 3,200, which is about 20% to 25% lower than where we're at today. This is why we want to, make sure that everyone remembers that first slide. We didn't put that picture of a goldfish up there to joke, because we don't take anything that we do as a joke. It's important to realize that in the short term, the market has the ability to go on these bear market rallies. But as the fundamentals of the economy continue to deteriorate, then the likely outcome is that something within these lines that we've just shown today is likely to happen. It just may not be immediately. So we don't want to have the attention of a goldfish and chase things. This is great. Let's talk about this, Carl.
So here's another one where we're looking at how S&P 500 earnings are affected by the business cycle and other commercial activity. We have S&P 500 earnings lined up against ISM new orders, and with a lag, or you're advancing the ISM new orders. And the point is that orders have been rolling over this last year, and that implies that S&P 500 earnings are going to be declining more over the next year.
Another catch up, right?
Right.
If people are ordering less things, that means that companies aren't selling as many things, which means they're not generating as much revenue, which tends to lead to less earnings.
Yeah, assuming inventories are, there's no change.
Right.
But there can always be inventory effects.
Now, again, this gets back to what we just said a little while ago about Wall Street analysts, typically getting their earnings predictions the most wrong around recessions, and then typically having to revise those, right, Carl?
Exactly. I mean, a key part of our outlook is that what happens in recessions is a little bit less predictable. And, psychology takes hold of a lot of people, not just, with how they handle their investments, but how they think about purchasing behavior in the real economy at all levels. And so this makes it harder for analysts to really estimate earnings,
Right.
When companies are starting to announce layoffs, and, maybe, they're not spending as much on expansion plans, or they're completely dropping them. So that's really what causes things to get chaotic. Because I mean, when normally analysts depend on managements of companies to give guidance during earnings calls, and if guidance is retracted and there is no guidance, like now, it's like everybody's best guess as to what's going to happen.
Yeah, and again, 2008 recession, going into that year, analysts were estimating earnings up here. Well, they had to revise them. 2001.
Yeah. So that uncertainty tends to get reflected in lower valuations.
Right.
So
let's talk about the money supply. What can you explain what the money supply is for those that don't know?
Yeah. So this is M2 money supply. So that is not just like hard currency, but all the deposits in banks, in checking and savings accounts, and also, where banks hold that money as well, with the Federal Reserve. And you can see that, the money supply tends to grow over time. And only when, there's extreme tightening by raising the Fed funds rate and, other things too, do you get money supply really contracting. And it's the quantitative tightening as well in the last year. And so since last spring, M2 has been declining slightly, and it's picked up recently. And some people have flagged this as kind of a startling thing, because it usually goes up, particularly when you've got inflation, but it's the first time since the 1930s that this is happening. So it's an indicator that potentially the Fed is over tightening, and we're not going to feel the effects of it all for a while, and we could be surprised by it all when we see it happen.
Great.
So here's another chart, another couple charts on liquidity tightening. Just that higher rates and more quantitative tightening leads to lower liquidity and lower stock prices. There's a high correlation over the last year with what the S&P 500 has done, and reserve balances held by banks with the Federal Reserve banks. And that's also correlated really well with the 10-year Treasury yield. And when you advance the 10-year Treasury yield 12 months. So the fact that we've had this big rise in rates, it really, like, over the last 6 months, in the 10-year, it implies that reserve balances are going to continue to decline over the next year, and stocks are probably going to continue to decline as well.
Yeah, it's a pretty clear chart that the S&P tends to follow bank reserves. And because of the high increase in interest rates, people are pulling their money out of a bank, depositing it somewhere to just buy a T-bill, right?
Right. It makes perfect sense. I mean, you're doing that. I'm doing that. Everybody's doing that, like taking money out of savings accounts and checking accounts, and and putting it into a place where they can buy T-bills and get their 4% instead of their 0.1%.
But yet again, another gap to fill, right?
Exactly.
So
here's
the
another
smooth, yeah,
here's
the
another recession
probability.
indicator that we look at. It operates with a little bit of a lag, so we haven't seen this really starting to increase yet. But this is the St. Louis Fed smooth recession probability. So they look at all the same variables that the National Bureau of Economic Research looks at to date recessions, and try to anticipate what's going on in real time. But the thing is that it takes a couple months to get the data. So we're looking at the reading here for November, and so you got to look at this with a couple months in the rear view mirror. So,
and one thing to focus on that we talk about, Carl, is typically anytime you get this number up to 10, you're basically in the recession, or it's starting.
Yeah, almost always.
The problem with using this to make decisions versus confirmations is that, like Carl said, there's a 3-month lag essentially on the data that comes in here. So by the time we get the next release of data, this could be much higher than 1. But I remember just a few months ago, it was like 0.16, right? So it's steadily increasing the probability that you are having, some form of a recession. And it's just another indicator that we're watching that is confirming the consensus that we have with this slowing economy. Now, this is my favorite. All right, I'll do this one because I love doing this one.
My favorite too.
Yeah. And this is it's a Econ PI, and it basically looks at the 4 main phases of any business cycle. So any business cycle in history is defined by 4 phases. You basically expand the economy. At some point in time, the economy starts to decline, and then eventually it contracts into a recession, and then you recover out of that recession, starting the cycle all over again. The only difference between any business cycle in history is just the length of time each one of these quadrants have. So what this does is it takes all of these different economic data points from building permits to vehicle sales to existing home sales to retail sales to industrial production, job openings, unemployment claims, and it plots them along each independent section of where they're at in the business cycle. And this little red dot right here is the mean of where all of these different blue economic indicators are located. So if you took the average location of where all these blue dots are, it would be right here. And the closer you are to zero, the more recessionary conditions are present. Now, I actually like looking at it numerically a little bit more. So yeah, again, you've got all of these different blue dots here, economic indicators. And then you've got this red dot that we just looked at. All you need to remember is 4.5%, okay? If we look at the three previous recessions, 90, 91, 2001, 07 to 09, about 6 months before those recessions occurred, that little red dot was at 13.9, 3 months, 8.3, and 1 month, 2.1. So this tells us somewhere within the next 1 to 3 months, you're going to start to see some significant changes in the economy. Some of the other indicators that we looked at were 6 months. Some of the other ones were about 12 months. So, if we had to average all those out within the next 3 to 6 months, this economy is going to look a lot different based off of the continued trends that we're seeing. And even if you wanted to use 91 as an indicator, we're at 4.5 now. 3 months prior to that recession, it was also at 4.5. And that puts us at 3 months.
Yeah, so we're probably 1 to 3 months away.
Yeah. Carl, you want to talk about this?
Sure. So this shows the evolution of that average of all those economic indicators through a business cycle. You start out in the contraction quad, then you get into the recovery, you get up into the expansion, then you come back down into the decline. And every business cycle looks that way. And so this is the most recent one right here, where you can see coming out of COVID, things were contracting, then they were recovering, and then they were expanding, and now they're declining.
Yeah. And look where we were in Q4 of 21, still clear in the expansion.
Yeah, so it all started to decline once the Fed started to talk about tightening conditions, taking quantitative easing away, and then starting to raise the Fed funds rate.
Right.
And so on the next slides, you can kind of see what this all looked like 1 month prior to the 2007 recession. It's kind of right there. Everything is a little more spread out than it is now, but we're basically in the same location.
Mm-hmm.
And then let's look at the next ones too, like 2001. Yeah, that's okay. Things are a little more spread out there, but basically your average of everything is right there, a little bit above zero.
We're at now 07, 01, pretty close.
Yeah.
And yeah, right. And why that would make sense, Carl, why each one looks different is because each recession is different, right? The culprits of each recession are different. So in 2007, 1 month before the recession started, you had a lot of people losing their jobs, right? Whereas in this recession, we haven't quite had that happen yet, right?
That's
so
right.
every recession
So that's
is
why those
absolutely different.
variables are up over there in the expansion quad, or they're not so much in the decline or contraction. But vehicle sales and home sales are in the contraction quad because rates have gone up, and there've been a lot of problems with making cars more expensive, supply chain wise.
So, Carl, let's talk about, just a little bit about the investment process.
This is roughly how we think about investments and making decisions. When we look at individual securities or an index or whatever it is that we're thinking about doing, we're always looking for risk-adjusted upside. We have an estimate of what the fair value is of the item that we're looking at, and some historical perspective on how much risk there is and where the current price is. And what we're looking for is mispricing relative to what we think the fair value is. And what we want is to be in a position, we want a significant amount of mispricing relative to the risk. So, lots of upside or margin of safety relative to the fair value. And that's a real key thing, because you don't want to be in any position for small gains. You want to be in positions for significant enough gains to justify being in there, or the position size that you have. So that's how we think about everything, whether it's individual securities or asset classes, indexes. And an important part of this too is knowing where you are in the business cycle, how the economy is doing, because how you position should be different based on whether you're in an expansion, whether the economy is peaking out, or you're going into a recession, or it's troughing and you're coming out of a recession. So we spend a lot of time on that, because that's where a lot of, in our view, a lot of the predictive edge is, and inefficiency is, around what's going on with corporate earnings, bond yields, et cetera. If you just look at where things are currently, that isn't going to help you figure out where they're going. You need to get out of the weeds and, look at the whole forest, and not be fixated on the trunks of the trees.
Right.
So
And just because
that's what we
something
try to do.
And just because something trades at below fair value, or even at fair value, doesn't mean that it's a good position to be buying. And why that's important to understand is because, we run a screen of, probably 2,000 stocks. And, of that, maybe 200 or so are really good targets of companies that we would like to add to at the right fair value price. And some of those 200 stocks are trading below their fair value. But what's equally as important is the earnings component to us calculating the fair value. And if we as a firm believe that we have a short runway, and 1 year is a short runway in the life of the majority of our clients, right? The majority of our clients are hopefully going to be retired for 20 or 30 years. So 1 year is a short period of time in the length of someone's retirement. Where we're at in the business cycle. So just because something's cheap doesn't make it a good opportunity to buy, depending on what the macro environment is looking like. So if we were in a position where we saw these individual positions trading below their fair value, but we were closer to the trough of where we need to be as far as coming out of the recession, that macro environment is completely different than buying something because it's cheap on the precipice of a potential recession.
Exactly.
Yeah. So again, our biggest word this year is patience, right? For the first time in 12 years, investors are finally getting paid to wait to watch the fundamentals of the economy improve. If we get roughly $200 a share of earnings for S&P 500 times a 15 or 16 multiple, that's roughly around 3,000. And currently the S&P is currently at 4,000. So what we don't want to have is the attention of a goldfish. We don't want to chase the shiny object. We don't want to chase the short-term returns. We want to be positioned well to hedge the recession, earn a good interest while we wait, and look to take selective opportunities at bat when those opportunities present themselves over the next year or so. So with that being said, if you have any questions, you're more than welcome to type them into the chat, and we will be happy to answer them. Okay, Carl, I've got one.
All right.
How long do you think the recession will last?
Well, recessions generally last an amount of time that is related to the amount of time that the yield curve spends inverted. It's how long it takes to slow the economy down, and then what the knock-on effects are from that. So I think as this unfolds, we'll have a better idea of that. But I'm guessing that we've been yield curve deeply inverted for 3 months now. Maybe the recession will start in the next few months, but based on the estimation on when the Fed could be cutting rates later this year, or maybe not in a big way until early next year, the yield curve could be inverted for a whole year. I would expect the recession to last about a year,
Yeah.
but it could be a little shorter, it could be longer.
Yeah. What happens if inflation goes up? I mean, we've started to see copper increase. I'm sure people who drive around have started to see gasoline go up. We've started to see some of those things actually take a tick up. Oil's up from its low. What happens if inflation actually goes up?
Yeah, I mean, there are a lot of reasons that could happen. But if it does, then probably the valuation on stocks will fall, and bond yields will, maybe go back up to where they were back in November and October. They probably peaked back then, but they could go back up and retest that level. So that's something that we would be looking for if that happened. We don't really expect that to happen at this point. It looks like we've had a few months now where inflation is compellingly coming down, but there are things that could happen to cause it to go up if there's any more military action in the world, for example.
Yeah, any kind of, and I've said this, for my last few meetings, the economy is at a point right now where it's on a frail foundation, and any kind of black swan event, and an increase in the war in Ukraine, or China invading Taiwan, or any number of events like 2001, what happened to the United States, can really quickly, or even COVID, can really quickly turn this market very fast. But my baseline scenario is that, we will probably see inflation come down maybe to that 4% or so, maybe 4 to 5% range. But until we get people unemployed, wage inflation is a big problem in the country, and we've got 4 million jobs open right now, and we need to absorb all of those. So that's 4 million people that need to lose their jobs at least, and that's an unemployment rate of 6%. So we could run into a problem where inflation actually comes down and plateaus. And obviously time will tell with that. And then the last one,
that's a likely thing that we're watching out for if the Fed flinches and eases early. But the hard work is probably going to be getting inflation from 4 to 2, as they've been saying that they want to do. And so we'll see.
We'll see. The last one I have is what would cause the market to go up?
Well, it's either two things. It's either bond yields coming down a lot, or it's earnings going up. And we just don't see either of those things really happening here. The Fed is not going to get easy anytime soon. That's not on the horizon. And the environment, the business environment, is getting worse, as you can see from all of these different sets of indicators that we've reviewed today.
Yeah.
So I think the odds, anything could happen in the short run. Stocks can do crazy things. The stock market's not as big as the bond market, so it's easy for traders to push it around. But I think it's very hard for stocks to go up meaningfully from here.
Right. Yeah, not only do we have the technicals working against us right now, but I think we'll have a pretty good idea of the direction of the market, at least in the short term, right? Goldfish short term, in the next 2 weeks. Earnings season is really getting underway starting next week, and we'll see how corporate earnings hold up compared to a lot of the indicators that we've shown today. And if earnings have to come in a little bit, that'll tell you the direction of the market over at least the short term. If they don't come in a little bit, you'll probably see a little bit of relief in the market. So that's all I have, Carl.
That's all I have too. Thank you a lot for joining us today.
We appreciate it. It's available for replay. So if we want to share it with anybody, just let us know. We'll post it on our YouTube channel, and we wish everybody a prosperous 2023. Stay healthy.